September 1998. A single hedge fund, run by Nobel Prize-winning geniuses, was leveraged to the hilt with $1.25 trillion in positions. In just 4 months, it lost $4.6 billion. One more bad day, and it would have triggered the complete collapse of the global financial system, forcing the Federal Reserve to step in and beg 14 Wall Street banks to bail it out in secret. This wasn't 2008. This wasn't the dot-com bust. This was long-term capital management, one of the most terrifying what-if moments in market history. And it's just the first domino in the biggest hedge fund disasters that nearly broke the market over and over again. But while those hedge fund disasters nearly shattered the entire global system, one legendary manager looked at the exact same 2008 chaos and saw pure opportunity. David Tepper of Appaloosa Management made the ultimate contrarian bet. The US government will step in and save the big banks. He was right. In the middle of the panic, his fund raked in over $7 billion in profits, delivered a 120% net of fees return, and put $4 billion straight into his pocket. While the rest of Wall Street was bleeding out and hedge funds were blowing up left and right, Tepper quietly turned the biggest market crash of our lifetime into the single greatest payday in hedge fund history. This wasn't luck. This was one of the 10 most famous hedge fund managers of all time, turning fear into fortune in real time. So how does one guy like David Tepper turn $4 billion into his own pocket while the entire system is melting down? Simple. He runs a hedge fund. Hedge funds are private, high-octane investment pools that take money from the ultra-wealthy and institutions, then use every weapon on Wall Street to make that money grow, no matter what the market does. They short-sell stocks they think will crash. They borrow massive leverage to amplify bets. They trade derivatives, currencies, commodities, anything that moves. The goal? Not just to beat the market, but to deliver absolute returns, positive profits even when the S&P 500 is bleeding red. Unlike your boring mutual fund that can only buy stocks and hope they go up, hedge funds are built for speed and aggression. They're lightly regulated, super flexible, and structured as limited partnerships so the manager gets a huge cut of the winnings. This is the machine behind every legendary trade you just heard about, the same machine that nearly collapsed the world in 1998 and minted Billionaires in 2008. And it all started with one guy in 1949 who said, "I'm not just going to ride the market, I'm going to hedge it." Imagine you're a rich guy with $1 billion in the stock market. You don't want to lose everything when the next crash hits, but you also don't want to settle for lame 7% returns. Enter hedge funds. They were invented in 1949 by Alfred Winslow Jones to do one brilliant thing: hedge your bets. You own stocks you love, but you also short the ones you hate, so if the whole market tanks, your short positions make money and protect you. In plain English, they exist to give investors absolute returns, profits no matter if the market goes up, down, or sideways. They charge the famous 2 and 20, 2% management fee every year just to run the show, and 20% of all the profits they make. That performance fee is what turns managers into rock stars, because their paycheck is tied directly to making you richer. No more hoping the market is nice to you. Hedge funds said, "We'll fight the market itself if we have to." And that's exactly why they still exist today, to turn fear, chaos, and volatility into pure profit. So who in their right mind hands over millions, sometimes billions, to these funds? Not you or me. Hedge funds get their cash from the biggest players on the planet. Ultra-high net worth individuals, think billionaires and family offices. Pension funds managing teachers and firefighters' retirements. University endowments, Harvard, Yale, the ones that need to grow forever. Foundations and corporations with massive cash reserves. They're called accredited investors for a reason. You need serious money just to get in the door. Minimums often start at $1 million or $5 million, and once your money's in, it's usually locked up for a year or more. The fund manager usually throws in some of his own cash first to prove he believes in the strategy. Then the big money piles in once the returns start rolling. It's a closed club. No retail investors. No public advertising. Just private deals between the ultra-rich and the managers who promise to turn their capital into even more capital, fast. Because in the world of hedge funds, millions don't just sit there. They move in seconds. Alright, so the big money's in the door. Now, how do these hedge funds actually work day to day? It's simple. A small team of sharp people takes that cash and attacks the markets with every tool available. Stocks, bonds, currencies, derivatives, even leverage to amp up the bets. They're not just buying and hoping. They're hedging, protecting against losses while hunting for profit no matter what the market does. Decisions happen in seconds. One good idea can move millions before lunch. Here are the main ways they play the game. Long/short. Buy stocks you love long. Short the ones you hate. If the whole market crashes, your shorts still make money. Arbitrage. Spot tiny price glitches between related assets and pounce before they disappear. Think buying one company cheap and selling its rival at the exact same second. Macro. Bet on the big picture. Interest rates, elections, oil prices, wars. One fund manager might short the entire British pound because he thinks the government is messing up. They also do event-driven plays, mergers, bankruptcies, or activist moves. Buy a company and force it to change. Bottom line? It's not gambling, it's calculated aggression. The fund's built to win in up markets, down markets, or total chaos. So who actually does all this? You've got two key players. The analysts are the idea machines. They dig through financials, run models, talk to company execs, check suppliers, even visit factories. Basically, they build the case for every trade. They're the ones grinding 12-hour days, spotting opportunities, then pitching them upstairs. Then there's the portfolio manager, the boss, the decision maker. He or she takes those ideas, sizes the bets, how much money to put on each one, decides how to hedge the whole portfolio, watches the risk, and says go or no. The PM also handles the big stuff, keeping investors happy, raising more cash, and making sure the whole fund doesn't blow up. Analyst equals research rocket fuel. Portfolio manager equals the guy who pulls the trigger and steers the ship. Together, that's how millions move in seconds, every single trading day. Alright, you've seen the machines, the strategies, the big money. Now let's live it. Picture this. It's 6 a.m. in New York. Our hedge fund manager, call him Alex, is already up, coffee in hand, flipping open his Bloomberg terminal on his laptop before his feet even hit the floor. He scans Asia's overnight moves, checks European opens, and pulls up global headlines. One wrong headline from Tokyo or London and his whole book could gap down. No panic yet, but the day has already started. By 7:30, he's at the desk in the sleek Midtown office. The team's small, just a handful of analysts and one trader. They huddle quick. What's moving pre-market? Any merger rumors? Alex reviews yesterday's positions, flags anything that needs watching, and cues orders. The terminal is his lifeline, live tickers, news wires, P&L flashing in real time. Millions are already in play before the US market even wakes up. 9:30 a.m. Bell rings. US markets open. The room gets loud. Screens explode with price action. Alex is glued to the terminal, watching his long/short book react. An analyst walks over. Oil rig report just dropped. 42 pages, boss. Alex dives in while fielding 3 calls at once. One stock, their long jumps on takeover chatter. Alex and the trader pounce, adjust the position, lock in a quick $1.2 million gain in minutes. Feels like a win, until the rumor gets denied and it reverses. That's hedge fund life. Seconds decide everything. Midday hits. 12:30 p.m. Working lunch with the CEO at a quiet spot downtown. No small talk. Alex is probing. How's the pipeline looking? Any surprises coming? Back at 1:30, an analyst pitches a macro bet on interest rates. Alex listens, grills him on the numbers, then says, "Run the model again. I want to see the downside." More emails, more Bloomberg alerts. He's juggling 3 screens, tweaking hedges, making sure the portfolio stays protected no matter what the Fed does next. Afternoon is pure execution. 2:30 p.m. News breaks on one of their holdings. Stock tanks. Emergency huddle. Sell? Hold? Hedge it. Alex decides fast, moves millions with a few keystrokes. The trader executes while Alex watches the terminal like a hawk. Positions shift. Risk gets dialed down. Another analyst slides in with fresh research. Alex sizes the new idea, approves it, and boom, money moves again. 4 p.m., market closes. The room exhales for about 30 seconds. Now it's review time. Alex gathers the team. Walk me through every position. What worked? What didn't? What are we doing tomorrow? They go line by line, winners, losers, the near misses. He updates his own notes, checks the final P&L, and makes sure the book is balanced for whatever Asia throws at them overnight. By 6:30, he's grabbing drinks with a prime broker and a couple of other managers. Still talking markets, still networking. Dinner with a potential investor runs until 9 o'clock. He finally walks out the door around 10 p.m. Phone still buzzing with late Asia updates. 12, 14 hours straight. No clocking out. Just constant pressure, constant opportunity, where millions really do move in seconds. And tomorrow, it all starts again at 6 a.m. But here's what they don't show you on the highlight reel. One bad decision, and it's over. Maybe Alex missed a red flag on that oil report. Maybe he sized the position too big. One wrong call and $87 million evaporates before the market even closes. Not paper loss, real money. Investors' money. His own money. Gone in seconds. Then the calls start. A pension fund manager who trusted him with $200 million wants answers at 7 a.m. A family office that's been with him for 6 years is already hinting at redemption. We need to talk about performance. Because in this world, underperforming the market isn't just embarrassing. It's lethal. Miss the benchmark 2 quarters in a row and the money starts walking out the door. No mercy. No, it'll come back. Just cold, quiet capital flight. Alex lies awake at 2 a.m., staring at the ceiling, knowing tomorrow he has to walk back into that office and make another call that could either save the year or bury it. Billions on the line. One man's judgment. Every single day. That's the pressure that turns hedge fund managers into legends, or breaks them. But when Alex nails it, when that one big call pays off, here's how the money actually moves. Remember that $5 trillion sitting inside hedge funds right now? That's real capital, pension money, university endowments, billionaire family offices, all handed over because they believe Alex and his crew can beat the market. Profits don't come from hoping stocks go up. They come from the edge. Spotting a mispriced asset before anyone else, shorting the overhyped ones that are about to crash, or letting algorithms fire off thousands of trades in milliseconds. One winning bet on oil, one perfect macro call on interest rates, one quiet arbitrage play, and the gains start compounding. Now watch how the cash actually gets made. It's the famous 2 and 20. 2% management fee on everything they oversee, so if Alex is running a $2 billion fund, that's $40 million a year just for showing up and managing the money. Then the real rocket fuel, 20% of every dollar of profit. Generate $500 million in gains this year. The fund keeps $100 million. Alex and his partners pocket a fat slice of that. That's why one good year can turn a manager into a multimillionaire overnight. And the speed? Insane. Alex doesn't wait for the market to think about it. Algorithms and Bloomberg terminals move capital in fractions of a second. One trade, one single click, can shift $50 million, $100 million, sometimes more, before the coffee in his mug even gets cold. Billions flow through these funds every single trading day, quietly, instantly, globally. No retail investor sees it. No CNBC ticker shows the full picture. It's just pure, high-octane capital in motion turning smart ideas into life-changing money. That's the wow. That's why the pressure is worth it. Everyone watches the highlight reel, the $100 million paydays, the skyline offices, the feeling that millions move at your command, and they think, that's the dream. Here's the reality most people never see. Alex doesn't live in a movie. His glamorous day starts at 6 a.m. and often doesn't end until after 10 p.m., 14 hours glued to screens. 3 meals eaten at his desk. Weekends half spent catching up on research. The pressure doesn't switch off when the market closes, it follows him home. One bad decision, one missed signal, and millions can vanish. The mental toll is constant. He second-guesses every call. Sleep is light because Asia is already moving while he's trying to rest. The fear of underperforming isn't abstract. It's investors calling at dawn asking why their pension or endowment is down 4% while the S&P is flat. It's not Lamborghinis and bottle service every night. It's decision fatigue so heavy some managers burn out by 40. It's carrying the weight of other people's futures on your shoulders every single trading day. The money is real. The lifestyle, not the fantasy you imagine. It's a high-stakes grind that pays like nothing else, but exacts a price most people would never want to pay. So here's the truth behind the machine. In this world, money isn't just made. It's managed under pressure most people never see. Alex and every hedge fund manager like him chase control. The perfect hedge, the split-second decision, the strategy that turns chaos into alpha while the market swings wild. They wield leverage, short the overvalued, bet on macro shifts, all to deliver returns when everyone else is bleeding. But control is an illusion wrapped in risk. One wrong call, one missed signal, one liquidity trap, and billions can evaporate. Leverage that magnifies gains can just as easily destroy them. The same tools that move millions in seconds can wipe them out in the blink of an eye. It's the ultimate high-stakes trade. Absolute freedom to chase outsized returns balanced against the very real chance that the market, the investors, or your own judgment turns against you. Hedge funds promise uncorrelated returns and lower overall risk for those who can afford them. But for the men and women inside the machine, they're the ones carrying the weight. So the next time you see a headline about another massive payday or another spectacular blow-up, ask yourself, would you trade your peace of mind for the power to move millions in seconds? Because in the world of hedge funds, that's the only question that really matters.